Welcome to the What to Watch video update. This is a video that I do about once a week and on an as needed basis where I really hone in on the things that I'm really looking at. I post a number of different videos. I have a video each day that I post. I have a weekly video, an intermarket analysis video. I also have another video called the deep dive video where I go through things that are not really blatant to us right now and charts that we're not really looking at, because we have to dig deep into those charts to see if they're telling us something. And then the last video that I do each week is called this What to Watch video. These are the areas that I'm really honing in on for right now. This is being prepared for Monday, June 3rd. Now, this video is going to be a little bit longer than usual because I'm going to take about the next probably 15 minutes or so in this video to explain the program that is launching Monday, June 3rd. If you're watching this on YouTube, you've seen this before, or you're not interested in hearing about the program, I will put a chapter mark right when this is over, and then you can go on and watch the rest of the video. If you're watching this on Rumble, in the comments section, I will put a timestamp down below where you can jump ahead and go on to the rest of the video that way. What I have is called the SPX investing program. And it's been around a long time, but I totally rebuilt it from the ground up. It'll be free for the month of June. I'm launching it on Substack, and I'll talk about the different things that are available. So if you sign up right now, you'll get at least the whole month of June for free. I'm looking at possibly locking it down in July. We'll see how things go, because something new like this, I'm just building everything from the ground up. There's a lot of bugs that need to be worked out and so forth. If you want to remain a member, it will be $97 a month. But this month of June gives you a chance to go in and just kind of look around and see if you like what you see. I like giving people a lot of time to decide. Now, if you think that $97 a month is a lot, which is quite a bit less than what other folks charge, but that's on a relative scale. Other people say $97, that's nothing. Okay, well, it may be a lot. It may not be very much, depending on who you are. I have, for everybody that enrolls, a thing called the affiliate program. Now, you're automatically an affiliate once you sign up, but you don't have to be one. This is something that is extended to you so that if you get somebody else involved in the program, for every month that they remain in good standing, half of your $97 will be covered from that other member. If you get two people involved, now all of your $97 will be covered. But you have to be careful with this. You need to pick good quality people that are going to stick with it, because if one or two of those folks drop out, that means that the responsibility for the $97 or half of that is going to fall upon you again. Now, I try to keep track of these things, and I'll send emails and let you know what's going on and so forth. And you can even go beyond that. Let's say you have 10 people that you think will really like this program and they end up enrolling. Well, the first two could go to cover your membership. And then the rest of the 10, the 8, that could be some supplemental income that you could earn for yourself. And every month that that member stays in good standing, you would get half of the $97. So it's a way to earn additional income for yourself. It's available if you want to use it. It's not required. It helps me a little bit with the marketing because I'm not much of a marketer. I like to focus on what I'm teaching in this program rather than trying to wheel and deal and get people involved. What does membership include? First of all, starting with Tuesday's video, because I've already done the video for Monday, I will be locking down the daily videos. You'll still have access to those and they'll still be free, but it's right as the market closes. So Tuesday's video, you won't see it until the market closes Tuesday. Then anybody can go in and watch it. If you're a member in the program, you can come in and watch it as soon as it's available for viewing. The real foundation of the analysis that I do is the daily video. And the weekly video, the intermarket analysis video, all the other videos that I talked about, those are supplemental in my view. It all points to the daily video. That's how we really hone in on what's going on with the market. And those are the most important. If you just like this what to watch video, if you just like the weekly videos that I do, that's not going to change. They'll still be freely available as I prepare them and post them. If you want to have early access to the videos, but you don't want to be a member, then it will be $19 a month. So it's less than $1 a day per video. So just think about that and see if any of those things work out for you. Also, I have a number of online courses, and it's well over 100 hours of instruction. I have 4 courses that I'm going through right now, and they're pre-recorded. I update them on a regular basis, and I change them around a little bit, and I try to update them as well with charts if I'm using those in that particular course. Now, if you go to YouTube or Rumble, there is a course called the Basic Course. It's already there, and it's been there for about 3 years. I'm updating it again to 2024 because some things in that course never change, but there are some charts, there are examples, there's things that I allude to that had to do with 2021 that don't really apply necessarily to 2024. And I'm constantly making tweaks and changes and things to all of the courses. So that will be rolled out first, and you'll have access to that as a member. The second course is rather lengthy and pretty involved, where I go through technical analysis. And I base it around the charts that I use in the daily video. And I go through and I talk about which indicators are most important, which ones do we like, but we may not use all the time because things are constantly changing. And I talk about all the indicators that I use and the rationale behind the process that I use in the whole thing. And then the third course will be strategies. Now, some of you probably are already implementing a strategy, but there's other strategies that are available to you that maybe you don't know about, or maybe you haven't had much of a chance to actually explore those, because we can take advantage when the market goes up. That's buy low, sell high. Well, we can also make money when the market goes down, and we can also make money when the market goes sideways. You just use technical analysis to figure out what to do. You just need to do the right thing at the right time. And so I talk about some different strategies. Some of these are a little more aggressive. Some of them are more conservative. And I try to go through all of these and let you be exposed to them and then say, does this fit my personality? Does this fit my risk profile? Do I have the time to be able to do some of these strategies? And then just see if this is something that you want to explore. Then the last area is the most important. This is mental analysis. This is dealing with our emotions, specifically fear and greed. You can learn everything in courses 1, 2, and 3, but if you can't handle things in course 4, 1, 2, and 3 aren't going to do you any good, because it comes down to you controlling your emotions rather than your emotions controlling you. And that's very difficult to do. It's easy to say, and we can come up with all kinds of theory and all kinds of idealistic things that say, oh yeah, of course, I'll never do that. But when you're in the heat of battle and you've got money on the line and you are having to make a decision right away about what to do, see, I try to remove as much of that as possible. And then we try to overcome our emotions, do things in an unemotional way as possible. And we just have a system that works day in and day out. There are times when I will put together what's called a live online course, where I'll take bits and pieces of all the courses and then go through and put it together. And this will be the kind of class where you actually see me, you can hear me, I can see you. You can have some back and forth with me. You can ask questions. We might go off topic just a little bit. And it'll pretty much be unique every time I offer that. And I might change it around, but this will be based on what people are telling me. Hey, can you go through more of this? Can you go through more of that? Can you stress this area? Can you explain that more in depth? And I will put those available kind of on an as needed basis. I don't really know what the schedule will be for that at this point. So you have, as a member, the opportunity to attend that class while it's happening, and then it will also be recorded. So you can go back and watch it again, or if you missed it, you can go in. If you're a member, you can go back in and watch it anytime you want. Then there'll also be a chat room that'll pretty much be open all the time. Now, I'm not going to be there all the time because, believe it or not, there are times I need to sleep and I actually do other things than look at the stock market. But it'll be a chance for you to ask questions, to get feedback, to maybe post an article that you found or something that you don't quite understand, and not only interact with myself, but other members in the program. Right now, I would like to not have it moderated. I want this to be a safe place where people can come. With all the divisive things that are going on in the world right now, it would be really nice to have a safe place that you can come to where we're only focused on the stock market. We're not talking about all those other things. And you're not going to be ridiculed if you ask a question because you're brand new. You'll always be treated with respect, not only by me, but I'll demand it of anybody that's in the chat room. And if somebody gets rude, they're going to be booted out. It's just as simple as that. I'm not going to waste my time with jerks when there are so many wonderful people that I can spend my time and actually make life better for everybody. So I don't want to have to moderate that. I will if it becomes necessary. But for right now, I'd like to just think that the people that are in this program are some of the best, and it'll go okay. It will allow for online posting. Maybe you have an article, a chart that you want other people to look at, and we can discuss that back and forth. It'll be a time of questions and answers, but we want to try to really keep it limited. Your post, we don't need some big, long 10,000 word dissertation that you come up with. If you want to do something like that, please set up a blog. And if you don't know how to set up a blog, contact me and I'll show you how to do it. It's free. And we want to keep it relevant to the program. We don't want to go too much off topic. Now, there can be some little offshoot things here and there because we all have different interests and different things that are going on. But the bottom line is we always want to stay within the realm of what's being done in the program itself. There'll also be video debriefs and as well as a review where I'm thinking now at least once a week, but it may be more often than that, where I set up a room and either on Zoom or Skype and people just come in there and they say, man, today was a really rough day. Well, man, I just needed to talk about it. Or man, I had the best week I've ever had. I wanted to tell people about that too. Or I really was struggling in this area or something really came through in that area. And just a chance. We're people that are also in the program, so they understand what's going on. We're kind of all in the same basic mindset here, and we can just talk about things. You can ask me questions. I can share what I think's going on, and just a chance to unwind, basically. Again, in another safe place. And these will be recorded in case you miss it. You can go back and watch it later, or if you did attend and you want to rewatch it, that'll be fine too. And then there'll be live sessions that I do. For example, I used to post something on a blog. I would type it out because it would be anywhere from about 6 to 12 hours from the time I get done recording the video for the next day before the market actually opens. Well, we have Asia, we have Europe, we have different things going on in the world, and things can happen. We also watch the futures a lot to see what we're looking at. We're looking at interest rates. We're looking at any news that may come out. And so I may do a pre-market open. And that will probably be a video because I can do those so much quicker than actually writing things out. And then if it's a really wild day, I may do additional updates. If it's a real sleepy day, I may not do any more updates for that particular day. I only post this. I try to make the pre-market open always happen. And I'm really going to push for that. But where I'm located right now, right as the market is opening, that's right when I get done teaching English lessons to Chinese children. And there's sometimes it's not really easy to make the switch. So it might even be not so much pre-market. It might be a little bit after the market actually opens. So we'll see how that goes. And then again, I'll post other updates as needed. And then if we're going through our plan here and we have a plan for that particular day and it looks like we're going to be entering positions anywhere from 15, 20, 25 minutes to a half hour before the market closes, because that's what we do. We get as close to the close as possible before we actually enter something. Then I might go live. Again, it would be a similar type of room through Zoom or Skype or message, something. And then you can all come together. We're giving each other support. We're bouncing around ideas. And then you can yourself then decide, okay, is this something that I want to do? Other people may decide, yeah, I'm going to jump in. Other people will say, nah, I just don't feel comfortable about this. So again, just a chance to work within a like-minded team type of an environment. Even though we're all different, we're all working towards the same goals here. And it might give you a little bit more encouragement, especially if this is new to you and you need to build your confidence. Then there's also a number of supplemental videos. These go beyond what is covered in the program. For example, I want to do a supplemental video on a thing called ESG, which is really impacting the stock market. And then are we going to go into a recession? Or are we not going to go into a recession? And I can do a supplemental video about yes, we are, or no, we're not, and compare the two. And then we can watch things over time, and I can do updates of that video to see, are we in fact going to go into a recession? Or I may read a book, or I may just come across a topic that I think is interesting. It's not within the program itself, but it's still connected. And so I want to do these videos more on an as needed basis. Sometimes there might be a number of different videos. Other times I may go a period of time and not really do much. It just depends on what's all happening at any given moment. And then this is something that folks probably are going to really like, is based on what is taught in the program. Now, if this is new to you, you're not going to understand that until you actually go through the strategies course. And that might be somewhere down the line. But I'm going to start putting out videos where I say, okay, based on the strategies that I teach, and you may not even understand them yet, so don't do them until you really understand them and you practice them. Here's some ideas that you might consider according to the criteria that is outlined in the program. And that'll be updated daily. And then we can come back and revisit anything later in the next video. And then there's also a thing called the daily journal, where on one sheet you fill out this page. It's a PDF. It can also be a spreadsheet. You can print it out if you want to, do it on your computer. And it's everything that you need to know for the plan that we're implementing for that particular day. And it only applies to that day. At the end of the next day, we reevaluate things again, and maybe our plan is the same. Maybe it changes a little bit. And so we have a sheet for each day, and it'll also be available as a PDF, where I have the version that I filled out just as an example, but you may reach different conclusions than I do. And that's good. That's what I want. I want people thinking for themselves. If you want to talk to me about this, here's an email address, and we can go back and forth, whether you like it, don't like it, you think it's a great idea, any feedback that you may have, you're welcome to contact me. You can leave a comment on the video, but if you want to keep it more private, here is an email address, and we can set up a time on Zoom or Skype to talk about things. If you want to discuss things more, maybe get to know me a little bit better, that's also a possibility. Okay, so now this is where I'm going to put the chapter mark, both for the YouTube video and then in the description for the Rumble video. This is where the video is going to pick up right here. So let's look at the things right now as of Monday, June 3rd, that are looking positive. Now, you can kind of vary this a little bit. There's a couple of charts. It's like, how come he didn't put that on the negative side? Or how come on the negative side, how come he didn't put that on the positive side? We'll just deal with that as we go through the charts here. Now, here we're looking at a daily chart. Now, for right now, I'm saying that this is positive. And because we have not broken support yet, we have come down. We're right about, we hit this pivot point on Friday. And I know it's hard to see with that big P right there, but we were able to bounce up off of that. And Friday's session, it was looking pretty bad, and we were turning negative. And I was talking about this in the daily videos, but then we hit the 50-day moving average at about the 5,200 level. And then we just turned and went back up. And that's what we saw. And so we saw a really nice rebound. The thing that we're trying to figure out now is there going to be follow through momentum? Is this the start of something, or was it just that one-day wonder that isn't going to continue? We won't know that until Monday's session. But for right now, we're above support. We have been coming down. We saw a bunch of these lines all coming together, and that was pretty major support. We broke through the 20-period moving average, but we were able to bounce back up as we got close. We didn't quite get to the 50-day moving average, but we were close. And because we had the up day on Friday, I'm putting this on the positive side. We're just about neutral right now when it comes to the fear and greed index. We're not extremely positive. We're not negative. We had been coming down, but then we're starting to bounce back up, which is why it's on the positive side. Looking at the VIX, where it really fell in Friday's session, and we're coming down to some pretty low readings currently with the VIX here. So that's showing some improvement as well. We're also keeping an eye on the VIX of the VIX, which is also dropping as the market's been coming down. And we actually closed below, if I go back over here to the VIX, we actually came down below 13 again. And that's a very low reading for the VIX. Then going on here, this is some research that Tom Bowley did. Tom Bowley is connected with stockcharts.com. I do have a subscription to stockcharts.com. It's where all the charts come from. And there are blog posts and people that do videos and offer their insight into different things. Tom Bowley also has another site called earningsbeats.com. I'm not a member of that, but I do get his daily and monthly emails. He did some research. Now, the numbers that you see here were based on late 2023, but the chart itself is as of Friday's close. When we get down into this green area where we're at right now, because we're down below 13, when you annualize the returns, when the VIX is very, very low, that's where we get the highest annualized return. If we bump up above 13, but we're still below 17, the returns are still quite high, but they drop off quite a bit. If we go above 17, but we're still below 20, the returns are still positive, but they really drop off again. It's when we get above 20, that's when the returns start to turn negative. Well, we're getting very low readings right now, so this tends to be more positive for the market. We were watching this, and I brought this up a week ago in the video. The skew index was right underneath this red area. We went up into the red area, stayed there for a couple of days, and then after Friday, we dropped back down now. So this may be over. We don't know. It could go back up. But for right now, this is the skew index, and it uses out of the money options to do its calculation, which is different than the VIX, which uses at the money options. And since we're coming back down, we don't know if this move is actually over. It could be, but we don't know also the direction, because sometimes when we get up into this red area, spike out and then drop, sometimes that's a top, sometimes it's a bottom, sometimes it's a continuation. So we have to use other charts to give us some context as to what's actually happening. Since we were going down as this was going up, and then we reversed in Friday's session, and then we ended up closing lower with this index, I would say that that was more of a positive signal. We were looking at potentially some kind of a bottom that we could come up out of. We just need to see follow through now for that to be legitimate. Looking at the advanced decline line based on price, we did come back up after we had been declining, both based on price and volume. And if you look at these lines, we're seeing volume a little bit stronger than price. I wouldn't necessarily read a lot into that. You can also see that up here where the green bar was up with price. It was up a lot more with volume. And that's usually a sign of something healthy when volume is leading price, especially to the upside. It's a negative sign when volume is leading price to the downside. Let me look at the new highs, new lows. We are declining with the 5 period and the 10 period. And that's because the new highs have been dropping off. Even as we were going down, we saw a little bit of an expansion of the new lows, but not very much. And then in Friday's session, we saw a contraction of the new lows and an expansion of the new highs. So I'm still treating this as positive when we just look at the bars, not so much the moving averages. The advanced decline ratio, we had dropped below 0 with both the red line and the blue line. After Friday, we were able to get back above them, back above 0 with both of them. This is also a smart money indicator, or the institutional indicator. This is called accumulation distribution. And a large part of the reason why it measures the smart money is because it's based on volume, not just price. And this is going up, and it went up in Friday's session. Even with the decline that we've been seeing, we never dropped below the moving average. So this is rather encouraging. This is really encouraging to me because I saw this as it was being played out here. The Chaikin money flow, yeah, it declined a little bit, but Thursday when we had the down day, the Chaikin money flow was actually up. And then when we reversed on Friday, the Chaikin money flow was up even more, and now we see the moving average going back up. So this is another smart money indicator that is looking more positive. Here's the Chaikin oscillator. We were declining there for a while. We didn't get below 0. We never did turn negative, but now we're bouncing back up after Friday. We're bouncing back up with the 20, 50, and 200 period moving averages. Now, these are calculated just based on the S&P itself. I have other moving average studies that look at the stocks inside of the index, but this is showing a real improvement from what it had been showing. Now, this is still technically negative, but I wanted to keep all these charts together. These are the stocks inside of the S&P that are above their 20-day moving averages, and we're still below 50. That means it's negative, but we are bouncing back up after it had become quite negative. And then we're also keeping an eye on this study. Back in April, we came down, we had a below 10 reading, and then we saw an up thrust move. And then when we compare that to what happened a little over a year ago, it didn't go right up after that, but you can see what the result was after we had that signal. We're wondering if something like that is going to happen again this time. Now, the reason why we're on the positive side is the 50-period moving average crossed back above 50. So that's turning more positive. We're also climbing back up above 50 with the 100-period moving average after dropping below, and we're turning back up with the 200 after we had been declining. We want to keep an eye on the 20-period moving averages. We lost them. We closed right down below this on Thursday. Like, uh-oh, we're losing support here. And then we were just going down, down, down. Well, we ended up reversing and then closing pretty much at the high for the day. And we were able to recapture these 20-period moving averages. So the short term, since we're above the 20-period moving averages, now that's turning back to positive. We also want to keep an eye on the 50. Notice how we didn't get quite down to the 50. It was more the 5,200 level. That seemed to be the critical level that we hit. And we even dropped below that a little bit. So usually we don't hit those things really exact. But then we were able to just bounce up off of this. So again, if we see more weakness, we'll be watching this. If we continue to go up, that will mean things are turning more positive. Here's all the moving averages together where we had lost the 20s and then got them back on Friday. Now, this is still positive. This is a weekly chart of the parabolic SAR, and the parabolic SAR is one of my primary indicators. The weekly chart is positive, but when we get to the negative side, you're going to see where the daily chart continues to be negative. The bullish percent index. The reason this is on the positive side is because we're still above 50, but we are declining. This is a different kind of moving average. This measures point and figure buy or sell signals. We've been seeing this coming down. We want to see this turn and go back up, but since we're still above 50, it's technically positive. The NYSE bullish percent index has also been declining, but still above 50. And then we're looking at the advanced decline lines. We came right down to the moving averages with the NYSE common stock, the S&P. We dropped a little bit below with the mid caps and the small caps, but we were able to bounce off of this moving average. And seeing this across all the different indexes, that's quite positive. And we look at the vortex, and I don't know what to call this. I guess I defaulted to positive because we had been positive. The green line and the red line are exactly on top of each other. We're getting the same reading for both of them. If we turn and go back up, the green line would go up and then it would turn positive. If we cross below, then it will likely turn negative. This is an indicator that I developed a long time ago. It's very simple. It's just a 20-period moving average of the open, high, low, close. But what happens here is it creates this little mini rainbow, and we were falling below it. Well, we closed above it in Friday's session, so we were able to recapture that. So that's also positive. And then we're looking at the cumulative advanced decline line based on price. We did go up with the S&P, and you see how we went up even a little bit more based on volume. That usually is a positive thing. We want to ultimately see it in price, but we can look for clues when we study volume. And then the cumulative advanced decline line for the NYSE just really shot up, and we're seeing the advanced decline line. It just about got down to the moving average and was able to bounce up off of that. And then looking at a weekly chart of the S&P, we're still well above this trend line. And this trend line goes all the way back to the 1987 crash. Large cap growth. We did fall. We didn't come quite down here to the 50-day moving average. But if you look really hard, you can see where we hit a low and then we closed almost at the high for this particular ETF. So that was a good solid bounce. The QQQs looked like they were dropping below their 20-period moving average, but were able to close back above it on Friday and close pretty much, well, not at the high, but near the high. Then here's the NYSE advanced decline line. I should have had this earlier, where we're seeing some improvement here. This is the NYSE common stock based on price, where we're going up, and a little bit stronger when we look at this based on volume. The Dow, which has really been one of the struggling indexes right now, it was able to get back above this pivot point, but it's still below its 50-day moving average, but it was up 1.5% on Friday. The NASDAQ came up to this pivot point and then was going back down. We came just about down to this pivot point and then bounced up off of that. And the NASDAQ 100 also came close to this pivot point, saw the pullback, came down to this pivot point, and then closed for the high for the day. But we want to keep an eye on this. For right now, it's positive. The momentum of the NASDAQ 100, as measured by the PPO, the price percentage oscillator. I think I said that right. We're in danger of dropping below the moving average. Now, if we get some solid upward move, that'll turn this back up. If we see any more sideways to negative action here, that's going to drop below and actually turn the momentum negative. The mid caps just about came down to this pivot point and we're able to bounce up. We closed above the pivot point now for the month of June, and we're back above the 50-day moving average. The Wilshire, this is another broad market measure. We came down to the 50-day moving average and then bounced up off of that and closed at the high. When we look at the total US stock ETF, we came down to the moving average and then bounced up and closed at the high there. The FANG index didn't close at the high, didn't come down quite as much, but did see a nice little bounce. And then looking at the semiconductors, this is a huge part of tech where we had been seeing some weakness, but then a nice little bounce back up to close the day. The tech sector did see some weakness, didn't quite come down to its 50-day moving average. And then we look at the Amex, the NASDAQ, and the NYSE, and we look at a 5-period moving average of the highs and the lows for all those different indexes. The reason why I'm bringing this up is we've been above zero for most of 2024. We did dip down as we were seeing some weakness. We're getting close to that 0 point again. We want to see this go back up to turn more positive in a broad market sense. And we look at a ratio between the tech sector and the 3 to 7 year bonds. We have come down, but we're just touching the high end of the rainbow. And you're going to see that a lot here. When we look at the soft landing versus hard landing scenario, soft landing means that we won't go into a recession. Hard landing means that we are in one. We came down to the upper end of this rainbow and so far have been able to bounce back up. We look at 3 to 7 year bonds and compare them to stocks. I've been showing this a lot in the daily videos. We want to see this ratio continue to fall. That means that stocks are outperforming bonds or bonds are underperforming stocks. A long-term look at the NASDAQ 100 going back to 2009, we're still above this longer-term trend line. And I'm not sure what the perma bears are going to do about this. I got the idea of this chart from a perma bear because they thought they were seeing something that was just, you could put all your money, take all your money out of the bank and put it into the stock market based on what they were seeing. We came up and hit a really high ratio. This was the dot-com boom followed by the dot-com bust. Then it took us went from 2002 to 2021, was that 19 years, to get back up to this same ratio again. And then we went into 2022. Well, we're coming back up here, and this is what they're just screaming and salivating over, is that we're hitting the same ratio again. I don't know what they're going to do now that we're actually going up and setting a new high with this ratio. And what this does is this looks at the NASDAQ 100, which are growth stocks, and compares them with the Dow, which is more value, the bluest of the blue chips, the best of the best. And now that this is going up, that's kind of raining on their parade a little bit. They were so sure that we were going to hit this and turn and then just start to fall. And that may happen at some point, but we're seeing kind of the opposite of that right now. We look at a similar study here, the QQQs to the small caps, also right on just a little bit below the blue line. We actually spiked a little bit above it for right now. And then we look at semiconductors to the Dow, just a little bit below the blue line, but actually spiked above it earlier in the week. The folks that are always bearish on the market, they thought we were going to come up and hit this and start to fall. We came up to this ratio level a while ago, and then we started to fall, and they're like, okay, this is it, baby. This is it. We're crashing from here. 80% decline going forward. Well, then we started going back up, and now things are kind of changing. And we look at the QQQs, the 3 to 7 year bonds, where we have been declining, but we're still above the rainbow. We look at the broad market, compare it with 3 to 7 year bonds, just coming up to the top end of the rainbow and bounced up a bit on Friday. The S&P 1500, another broad market measure, coming right down to the rainbow and bouncing up slightly. The Eurozone, which is stocks in Europe compared to American bonds, coming down to the top of the rainbow and bouncing up. We want to keep an eye on the 10-year yield. If it's going down, that's going to help stocks. If it's going up, that's going to be negative for stocks. Now we go over to the negative side. This is a bit of a problem. This is one of my most primary indicators, and I base most of what I do and a lot of what I teach around this particular indicator because we can get so much from it. We want to know if we're trending, and if we are trending, what's the strength of that trend? And if the trend is strong, what's the direction of that trend? And that's what we use with the ADX. The black line is the ADX itself. And right now it's below 20. So that means a non-trending environment. It's also below its moving average. And I plot the moving average on here, which means that it's a weakening trend in a non-trending environment. Then we see where the red line crossed above the green line. That means we're in a negative environment right now. So we need to see more follow through to turn this back more positive, have the ADX go up, cross above 20, cross above its moving average, and then see the green line continue to go up as well if we're going to turn more positive. Right now, based on this chart, we have to default to negative. Then looking at the equity put call ratio going over the last 5 days, we came down to a very low reading and we've been going up ever since then. And if you look at other times when this was going up, that ended up putting pressure on stocks quite a bit of the time. We look at the momentum of the VIX, which had been getting to a very low level, and we did get, we're down below 13 on Friday, but the momentum with the downward movement that we saw in stocks was making the VIX go higher. So we're seeing the momentum actually turning positive now. We look at a 20-period double and triple exponential moving average study. The reason this is negative is we've fallen below both of the lines and the lines are starting to turn down. To turn more positive, we need to get above both the green line and the blue line and see the lines turn back up. A very similar thing that we're seeing here with a 50-period double and triple exponential moving average study. We were holding up above for a while. Well, then we dropped down below. Now we're a little bit above the red line, but we're coming back up to the blue line. We want to get back above this and see this continue to go up. That's more intermediate term. And then Friday was the only day that we really saw above average volume. We've been really dropping off. Even when we were going up, even when we were going down, we were seeing volume tapering off. Well, we saw a huge spike on Friday. It was the end of the week. It was also the end of the month. It was not the end of the quarter. That won't come until the end of June. So we might have seen some window dressing going on there. There's a momentum study. This was developed by Swenlin. He developed the price momentum oscillator. That's the indicator right here. Then we break it down a little bit based on price and volume. We are negative. And then there's some studies that he has developed to go with the PMO. When the PMOs inside of the S&P 500 are rising, this is going up. We got to an extreme negative reading and have been bouncing up. So that's showing some improvement. These are the buy signals that are being generated. We're ticking back up after we had been declining. The PMOs that are above zero had been declining and is now starting to flatten out. We look at all of our momentum oscillators, and these are slower, and they had been turning more negative, so it's going to take them a little longer to actually turn back positive. We're no longer extreme with the slope indicator here, and we're going down with the TSI. These are our short-term oscillators. Then I have 3 intermediate term, the MACD, the PMO, and the PPO, and they're crossing over negative, not quite crossed over yet with the PMO. Then I have 2 longer-term oscillators, TRIX and the KST. They're rolling over, but they haven't quite crossed below their moving averages yet. We need to see more follow through if we're going to change these momentum oscillators back to positive. Here is the daily chart for the parabolic SAR. We have the dots on top, and that to me is quite negative. This is a primary indicator to me. The NASDAQ 100 bullish percent index. Notice we were declining with the S&P, but we were still above 50. Well, with the NASDAQ 100, even though we saw a nice little bounce back up on Friday, this is continuing to decline, and it's also below 50. So that is just flat out negative. The S&P McClellan oscillator, it is improving after getting extreme negative, but it hasn't crossed back above zero. Anytime the S&P McClellan oscillator is below zero, that makes the summation index based on price decline, but it might be slowing down a bit. And we also are declining, but possibly slowing down based on volume. We look at the NYSE McClellan oscillator, also improving, but still below zero. So the summation index based on price and volume continue to decline. We look at the Swenlin trading oscillator. I mentioned the name Carl Swenlin. He developed the PMO. Well, he also, believe it or not, he developed this indicator that just happened to have the same name, Swenlin. And this is sometimes a primary indicator to me and sometimes not, because it can lead us astray sometimes. As we were going up with the S&P, this was a warning sign that I was seeing. We were going down based on price and volume, and we dropped below zero and actually turned negative. Well, even after Thursday, when we had a down day, this started to tick up, and then it just continued to tick up after Friday. So this is still negative, but it's really showing some improvement. It'll turn positive if we can go back above zero. And this could be positive, could be negative. I just want to keep all these charts together. This is an intraday chart of large cap growth, which is blue, which did bounce back up, but it had been declining. This was more negative when the blue line was below the red line, but then in Friday's session, we saw, actually it was in Thursday, we saw a bit of a switch and it's showing some improvement, but we need to see more follow through with this. Also looking at a growth to value ratio for the S&P, it did decline even though it bounced back up, but it didn't really scream to the upside like the rest of the market did. Earlier in the week, value stocks have just been getting hammered, and that's where we saw a lot of the bounce in Friday's session. Too early, in my opinion, yet to really make some kind of a dogmatic conclusion about that, but we would like to have seen growth do better than what it did on Friday. Looking at the small caps, we actually declined when we look at the growth to value ratio. We also declined in a big way with mid cap growth to value, and we're declining with S&P growth to value. That's a warning sign. We want to see these going up, not down, if we're going to see some more follow through. Now, there are times when this can go down and the S&P can go up. There are always exceptions. I'm just looking at this in a more general sense. This one was looking good even when we were going down. This is a growth to value ETF study where we had been going up and we actually declined in Friday's session. Then we look at discretionary to staples where we just ticked a little bit. We're not seeing any real follow through strength here. So this is still a concern to us. We look at the Qs to S&P with our growth to value ratios where we're coming back down to the moving average. We're still below a declining moving average with discretionary to the S&P, and we're coming back down to the moving average when we compare large cap growth to large cap value. So we had been seeing an improvement with the growth to value with the large caps. Now we're not. We're seeing more weakness with the mid caps and also more weakness with the small caps. We want to keep an eye on the staples to tech ratio. When this is going down, that means tech is outperforming. That usually means the market's going up. We started to spike up. We came up to the 200-day moving average, and then we're going down, but now we're starting to go back up again. Looking at 1 to 3 month T-bills, which you could call cash, and comparing with 3 to 7 year bonds, we're still going up with this ratio. To be more positive, we want to see this ratio going down. Looking at 1 to 3 year bonds and comparing them with 3 to 7 year bonds, also continuing to go up. We want this to go down. Looking at TIPS, which are Treasury inflation protected securities, when folks are worried about inflation and interest rates going up, they get into TIPS and they outperform. We were seeing that starting to change, but now we're going back up with this ratio. We want to see this ratio going down. Looking at home construction and comparing it to 3 to 7 year bonds, we did see some weakness, but a bit of a bounce on Friday, but we're more inside the rainbow currently. The S&P to utilities ratio, this continues to go down. We want to see this go up to be more positive. And staples to S&P, this is still going down a little bit here, but we ticked back up on Friday. We want to see this really continue to fall to be more positive for the S&P. Looking at the staples sector, this is a defensive area. It came down to its 50-day moving average and then bounced up off of that. Usually when the market is favoring staples is before we're getting set for a decline. And we also are seeing that with utilities that I'll show you here in just a second. This is a bit of a concern to us, so we're just keeping an eye on that. And here are the utilities, which has just been screaming. Then we saw some profit taking. Now they were back up in Friday's session, and this is a more defensive part of the market. Then here's a thing called the Hindenburg-Omen, and this is all, the perma bears are all excited about this. What stockcharts.com has done is there's 3 criteria that you need to do for a Hindenburg Omen. And if you know the Hindenburg, it was a big blimp and it exploded and all the humanity, and Led Zeppelin put it on their cover. And well, what happens here is it measures 3 different things and then it's charted right here. We saw a spike up back in February, but for this to be a legitimate signal, there has to be 2 spikes within 20 trading days. That didn't happen back in February. We just saw another one triggered this past week. Now, by the end of June, we're going to need to see another spike for this to be confirmed. In the recent past, when we've seen multiple spikes, you can see we saw a decline here back in 2019. This was the COVID crash right here. And this was the big end of 2021 going into 2022 that led to a severe downward move in the market. So we want to pay attention to this. The thing to be aware of, there's folks out there touting that we've already hit a Hindenburg Omen, but we haven't seen a confirmation yet. They're touting it as though it's actually here already. It needs to be confirmed before it's actually legitimate. Then looking at the dollar, it's still in an uptrend. We did fall down from the 105 range. We're back into the mid 104s. The dollar going up typically puts pressure on stocks. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.